Hey everyone, we got another company here for you today. This is an NEMT company, meaning a non emergency medical transport company. This one's based out of New York. Same as all the other ones. We're going to go and break down the deal. Then we're going to go and break down the financials. I'm going to show you what it looks like if you wanted to structure an offer for this, obviously based on the information we have. This is first impressions. So let's dive in. So, non non emergency medical transport. It's a mouthful. This basically does non ambulance care or non ambulance transport from hospitals, from other facilities, from any mix of that. And they do have their breakdown here somewhere, I think. But basically, asking 2.5 million, cash flows at 500 grand, a little under six, revenues at 1.8. That margin is a bit high, so likely there's some expenses that aren't being added back here. My guess is either real estate or something along those lines. Established 2009, so pretty decent time in business. Listed with VBB. I have nothing really bad to say about these guys other than just, their website kind of sucks. It's really clunky, but they, in our interactions, have been pretty decent, so definitely can't complain there. Seller financing is available. It's kind of good to note this out. So obviously there's some type of structure that they've talked about here. Let's find out a bit more. Long established, 16 years, family run. Not always the greatest thing to hear. Depends how involved the family is and how many people need to be replaced at the end of the day. So that may explain the margin. So if there's like a husband and wife that do all the dispatching, reality is there's two salaries missing. So pretty significant. Normally for these types of companies, about a 15 to 20% margin when run pretty well is usually what we see. When they own the real estate, sometimes that goes up a bit because, storing all of these vehicles, it does take some space. And then sometimes from there, if you can really, if you offshore dispatch or something like that, sometimes it goes up by another couple percent. So licensed 12 central New York counties. That's good. A unique MLT dot license. So I guess this is really going to depend on if this transfers with the company, which it's not going to be super clear until you dive into it. But as long as it does, nothing wrong with that. That does mean you'll have access to certain contracts, others won't. Um, Serving the VA, that's good. That's recurring. Medicaid, good. That's recurring. Schools, interesting. Inevitably, it's a recurring contract. Looks like, which is good. Private pay and hospitals, always good because those are recurring. And Department of Corrections, that's an interesting one. So that's definitely obviously recurring as well. So they do have some good contracts here, at least from the looks. You need to really understand the concentrations to see how viable they are and whether there's potential to expand or whether they will naturally expand because inevitably there's always more need and use. Um, let's see here. So they're just listing out all their different contracts, which all look good. I guess there's another contract on the table, $2 million potential. In this space, especially with these types of companies, really like capital expenditure, basically meaning like investment in new equipment, is a very heavy thing. So having these contracts, it's great, but when you're talking about doubling the revenue, that also means you have to double the fleet size. And I'm sure for something doing 2 million, I'm sure their fleet number is probably somewhere in here. Here we go. 23 late model vehicles. On average, I'm sure you're paying maybe 50 if you get them really beaten down used, 75 or 100 grand if you don't. If you have to double that fleet to do $2 million in new revenue, you have to invest more than that in new fleet, right? So it's great to have those contracts, but having a good stable of existing recurring to start for a new buyer is typically better unless you're getting this for a steal. And a 5X on SDE, it's not a steal. So you are paying, or at least the asking is relative top dollar. So you're not going to have cash flow unless you're coming in with a bunch of cash on hand to be able to service this new potential. You really aren't. So, not much point in representing this unless the price was accordingly low cost, or they're willing to take a really delayed type structure on a bunch of that money to allow for that reinvestment in capital expenditure. But let's see. 23 late model vehicles, well maintained. They had 47 pre-COVID, which is interesting. Realistically, most of these companies had a boom during COVID. and a bunch of them have kind of stabilized now. So surprising that they basically cut their fleet in half. Turns away dozens of trips due to fleet limit. I mean, we'd have to see what the reason for sale is. If it's purely retirement, that somewhat explains this, but cutting your fleet in half is pretty significant. I could see toning down maybe a handful of vehicles a year over the last 5 years to tone down, but you'd still be, close to 30 vehicles, I'm sure. Um, High unmet demand, revenue mix. Here we go. So 69% Medicaid. So you'd really have to investigate how profitable this is and whether it's worth keeping that percentage, or whether you want to see if you can increase here where you're going to get more revenue for time on the road and for basically per mile. Okay, Medicaid rate increases 36% in some counties. That's pretty solid then. So this will kind of solve itself, obviously, based on what they're saying here. Let's see. So they have a repair facility, which seems like this is the real estate. Full-time mechanic. That's good to have on staff. I'd be surprised with this margin. It's surprising to have a full-time mechanic on staff, unless this is a family member. And 2-acre property for storage. It's available for $750. I'm assuming that's the facility they operate out of. So because they're offering this and they're kind of saying purchase or lease, there is a good chance they're not paying for this. That also helps explain the SDE margin here. So there's a good chance, I mean, call it reasonable cap rate, like 75 grand a year, you'd have to take out of this to account for a lease, which we will do when we break down the numbers here. Nothing else that seems really interesting here, I guess, here. So for the diversity of contracts and demand, adding vehicles, so they've already kind of broken that out. So 80 grand of vehicles, approximately what they're spending. So again, to service, $2 million more in revenue, roughly double, you're effectively going to have to invest more than that, even still, in equipment to get another 23 vehicles. Owners at retirement age, that's good. So at least retirement is the focus. Seller seeking someone local, no problem. Proof of at least $1 million in funds and experience operating. My guess is, here you go, right here. No private equity, no SBA bank financing is available, though seller financing is offered for the property. This in itself is going to shoot them in the foot, and my guess is this is probably why. I'm pretty sure I've seen this listing for quite a bit. It's probably why it's been sitting. So if it has been sitting as long as my guess is, they're probably changing their position on this, and they're probably open to financing, likely conventional or some variation of, but you could probably still get away with SBA. The other reason why they might say this is primarily because their discretionary is so ridiculous that it won't be SBA bankable. But we're coming up at the end of a year, so there's a chance that if they have been sitting for a while, they'll be willing to change their tune, bite the bullet, pay the taxes they need to for the 2025 year, in which case this can be bankable even with one solid year showing, because their margins seem pretty decent. Now, that said, seems like they're basically willing to offer $1 million through cash. Here. So 1.5 down, 1 million for 8 years. So they're basically going 50-50. So, 3x SDE on close, which is already ridiculous for this type of company to pay 3x SDE, 3.5x SDE. Because again, when you pay rent and potential for the family members to be the main core dispatchers and stuff, you're actually paying like 5 times EBITDA on close, plus paying what would be here, another 3 times. You're paying 8 times. I'd say, and we're going to go through the numbers here in a second, there's a good chance this is going to get cut down to hell to like a proper reasonable offer. But that's kind of the norm for a lot of these Main Street brokers. Vested Business Brokers is more a Main Street broker than they are a M&A broker. And what I mean by that is an M&A broker, like they handle 3, 5, 10 million, 20 million in enterprise value, or potentially higher, where they need to be broker dealer licensed. But when you're Main Street, you're dealing with 200 grand companies all day long, $500,000 companies all day long, $1 million companies all day long. Oftentimes the multiples that you list at are very high because you expect them to come down and people to negotiate. So with that said, let's break down the numbers. So they're asking 2.5, and I'm going to assume you're going to be able to get SBA here, which is just a matter of being adamant about it more than anything. Even if the seller doesn't really want it, at the end of the day, if they're sitting for a year, they will come to the table, I'm sure. So This is our just quick vet calculator, available to everybody online. Feel free to go to the website and play around with it. But we have revenue here, we have cash flow here, we have purchase price here. Interest rate, this is SBA, pretty standard to get 10% in a worst case. We're going to leave that. Cash flow discount. So like I said, there's probably like 75 grand a year in rent that is not currently being accounted for here. Maybe there's a small part because it sounds like if they know enough to get facility license and everything else, there's potentially a chance they also know enough to separate out into a new entity and be able to take those tax mitigations. So my guess is there's probably some small amount of rent, but not enough for the market value. So I think a cash flow discount at 15% does make sense here. So roughly, what is that going to be? 70 grand a year. Might be a little bit high, but I'll say that's probably within realm. Operator cost. They don't really mention how it's handled. They don't really mention employees. So I'm going to just assume there's one owner that's kind of a full-time operations dispatching, and it's not quite like New York City by any means. So maybe like 80 grand to replace that person with someone else that'll take over their responsibilities. I think that's probably going to be within realm. You are getting equipment, depends how late model the vehicles are, but my guess is they've already been all depreciated. So you're definitely going to want to structure working capital within the deal. And realistically, this purchase price is going to have to come down, but I want to show you what it looks like before we do that. So my assumption here is you are going to negotiate your own 2 months, 3 months of working capital in the deal. Roughly, I'm sure it's in excess of 350-ish, 300 grand. That's going to be within that you're going to have to get as like cash or AR or some variation of. But let's hit calculate here. I'll walk through the numbers and then I'll walk you through the purchase price that I think realistically is where it needs to be. So core assumptions we're making here as part of this calculation, just to break down: interest rate 10%, SBA somewhat standard, amortization period 10 years. We're including rolling due diligence and closing fees. So that's cost you're going to pay for SBA guarantee, for the lender to do their closing costs, for a lawyer to do a purchase agreement, as well as due diligence, for financial due diligence to do a proof of cash or quality of earnings or some variation of. And then we're assuming that you're putting in 5% against total project costs. It's just, new standard minimum based on SOPs for the SBA as of right now. So as you can see, if they're only holding like a 10% note, basically it doesn't really cash flow even lender minimum. Even at 20%, holding $500,000 still doesn't even really meet lender minimum. Them holding a little over what they've asked, so 1.2, so basically 50%, half and half, and then you giving them about $1 million and some change on close. That does get you to some reasonable debt service, right? $192,000 after this $80,000 operator cost. Not bad. However, oftentimes, especially because you're not really going to want to, if you're putting in 5%, you can't really amortize the full note the way they want to in 8 years with an interest rate and everything else. Cash flows don't work that way. You do want to reduce the seller note and instead just increase the amount they're getting as cash on close. It's going to make more sense for you in the long run because SBA is a little bit easier to work with than a seller note, where all of a sudden they want sweeps of cash here and there, and their lawyer's going to throw in more stuff to try and secure them. You might as well deal with a bank where everything's simple and clean and clear, unless the seller is very flexible, which in this case depends. You have to see as you have conversations. So with this type of deal, 545 is what they're claiming as cash flow. We're discounting roughly about 70 grand, and then we're carving out an 80 grand operator salary. So this is actually being reduced by about 150 grand. So realistically, the cash flows or free cash flow or normalized EBITDA is like 400 grand, right? On 400 grand, this purchase price is crazy. 400 grand, 3 to 5 times is basically where you want to be within that type of free cash flow or EBITDA. In the best of case, 5x on 4 grand is 2 million. And I'd say that's high, but if their vehicles are all in the 2020s, it's reasonable. If their vehicles are all in the 2010s, I would say you want to be more like 1.7 or so, basically like between 4x ish high end. And that's simply because you're going to have to spend money on new vehicles or on repair or whatever variation of CapEx pretty shortly after close. So let's assume everything is solid. You're buying into vehicles that are less than 5 years old. Um, $2 million purchase price, more within realm based on actual free cash flow, operator carve out cash flow discounts and everything same. And if you have them hold more like a 20% note, we're at least hitting more like debt service minimums of where you want to be for room of comfort, right? So a lender minimum, depending on structure and whatever else, 1.25 really is where most lenders get baseline comfortable. And that means that your cash flows cover debt service by a multiple of 1.25 times. So if your debt service is $1 million, you have cash flows of 1,250,000 coming in, roughly. We like to see 50% plus. And what we really like to see is more like 2 times. So, basically, if you're doing $1 million in cash flow, your debt service is $500,000. We more like to see that. But something like this, if you can get a 20 to 25% seller note, you're cash flowing 130, 10, 12 grand a month to yourself after placing in a manager and placing in someone to replace operational responsibility. So you have wiggle room. If you're the one that needs to step in, you're still cash flowing over 2 times. This becomes a deal that makes sense, right? You're still going to have room for capex and everything else. If you wanted to be a little bit more shored up and padded, you'd want more like a 25% note. Maybe it's half or all of it on full standby, and you just wipe it out after a couple of years as you pay down debt. That's more the type of deal that'll make sense for something like this. However, to be honest, this is more of a not so great deal. This is one that I would probably say, for any of our folks, won't make any sense unless we can get the price down by at least $500,000. What I would personally want to see to be comfortable on a deal like this is probably about a $600,000 decrease from where their asking price is, maybe as much as $750,000, because that's more in reality. Now, this is without seeing all the details. Maybe they already are paying market rent. Maybe the owner's already out of dispatch, but I'm just making assumptions here. Based on these assumptions, I'd probably want somewhere between $500,000 and $750,000 discount to get it into a realm where it makes sense. Basically, do SBA, pay the seller as much as we can up front, 80% ish, and then the rest on deferment and structure as the business proceeds forward and as we make sure that the vehicles make sense and contracts retain and all that. So that said, that's the breakdown. By all means, if you're on YouTube, go ahead and hit subscribe, hit like, comment if you want us to look at other types of deals. So if you have a particular deal industry you're looking at, let us know. I'm happy to go and look for deals, break them down, and that way you have a sense of how we look at deals in that space. Or if you have particular areas that are of interest, maybe you're in Pennsylvania and you want to look at more Pennsylvania deals, we're always happy to go and find deals in Pennsylvania and break them down. But otherwise, see you in the next deal.